If you've ever felt torn between picking stocks like Apple, Tesla, and Nvidia, or simply buying a broad ETF like the S&P 500, this video will finally give you clarity. Let's begin with something simple. Historically, most individual investors underperform the market, and the market is represented by broad indexes, which are exactly what ETFs track. Now compare that with individual stocks. Amazon turns small investments into fortunes. Clearly, individual stocks can build wealth much faster than ETFs. But here's the catch. These are the winners we talk about after the fact. What people forget is the graveyard of stocks that didn't survive. Blockbuster, Nokia, BlackBerry, General Electric, Lehman Brothers. Many of the companies once considered safe crashed, collapsed, or disappeared entirely. When you buy individual stocks, you're betting on winners. When you buy ETFs, you're buying the whole field, and the winners naturally carry the portfolio over time. Let's look at a historical example. In 2000, during the dot-com bubble, individual tech stocks soared and then crashed more than 70%. But the broad S&P 500 ETF recovered fast because diversified ETFs weed out losers automatically. Companies that fail drop out of the index. Strong companies rise. The ETF self-corrects without you lifting a finger. Now let's talk about volatility. Individual stocks move violently. It's not unusual for a stock like Tesla or Meta to drop 20%, 30%, even 50% in a bad year. That creates emotional stress, and emotional stress leads to bad decisions. Many beginners sell at the bottom, panic during crashes, and end up losing money even when the company eventually recovers. ETFs, on the other hand, smooth out volatility. When one stock crashes, the rest hold it up. A 50% crash in a single stock might only be a 1% or 2% impact on a large ETF. That's why ETFs allow investors to stay invested longer. And time in the market is the real secret to wealth. There's also risk concentration. When you invest in individual stocks, your entire performance depends on a few companies. If one goes wrong, fraud, bad earnings, competition, regulation, your money takes the hit. ETFs spread risk automatically. You're not exposed to one CEO, one scandal, one product failure. You're invested in an entire ecosystem of companies. Now, let's talk about something most people never consider: probability of success. Historically, only about 10% of stocks outperform the market over 10 to 20 years. The rest either match the market or underperform. In other words, picking a long-term winner is like finding a needle in a haystack. But buying an ETF gives you all the needles, and you don't care which one becomes the next Apple or Nvidia. You own them all. But does that mean ETFs always build wealth faster? Not necessarily. The biggest individual stock winners always outperform ETFs by huge margins. But they only benefit the investors who chose correctly, held for decades, and survived all the crashes, dips, and emotional storms along the way. Most people don't. ETFs maximize consistency. Individual stocks maximize potential. ETFs reduce risk. Individual stocks amplify it. ETFs build steady wealth. Individual stocks create outliers, big winners and big losers. So, which one actually builds wealth faster? For most people, the answer is clear: ETFs. Not because they have higher maximum returns, but because they create higher real returns, the returns people actually achieve in the real world. ETFs allow you to stay invested, avoid emotional mistakes, and benefit from long-term market growth. But this doesn't mean you can't own individual stocks. Many investors use a hybrid strategy: 80% ETFs for stability and long-term growth, and 20% individual stocks for excitement and potential upside. This gives the best of both worlds: broad diversification plus room for high-conviction bets. At the end of the day, building wealth isn't about chasing the highest return possible. It's about choosing a system you can follow consistently for decades. ETFs make that easy. Individual stocks make it hard. So the question isn't which builds wealth faster in theory. It's which builds wealth faster for you based on your behavior. And for most people, the answer is simple: low-cost, diversified ETFs. If you enjoyed this video, hit like, subscribe, and turn on notifications. We post new videos every day. And comment below: do you prefer ETFs or individual stocks?